I'm Steve Glenn, CEO and co-founder of ARF Financial, and this is Celeste Dealmanuoir, Senior VP of Sales. And we've been together about 18 years with this company. You're probably wondering, why in the world would a lender want to loan money to restaurants? You know, the banks certainly don't like to do such, right? We used to do marketing for restaurants. Starting in the early 60s, the family that provides our funding started a little program up in Michigan called the Entertainment Publications Book. Have you all seen the entertainment books, past books, Gold Sea books over the years? Well, that's what we did for years and years. So we worked with restaurants, kind of in a marketing aspect. We sold that company in '92. It was about a $400 million transaction. And that's where our money comes from to lend to restaurants, and also our love of doing business with restaurants. It's kind of in our DNA, in our blood, so to speak. So in 2000, we started ARF Financial to provide a kind of a custom product for restaurants. Back at that time, there was no fintech, there was no online lending. There were banks and there were restaurants, and in many cases, without the proper collateral, the banks wouldn't do anything for the restaurants. So we stepped in and created a custom platform for restaurants where we provide the collateral. We put the money in the bank. The bank will then loan the money to the restaurants, so we don't have to ask for collateral. These are all unsecured loans. So that's a little bit about us. So Celeste is going to talk a little bit about the industry, and then I'll come back with you here shortly.
Hi. So my name's Celeste Deal. Like Steve said, we've been working together for 18 years. I started with ARF when I was 10. So yeah. But no, we're like a family, and I'm excited. I love working with restaurants and really consulting their business to help them understand all the options that are available for funding. Because there's a lot of options out there. So we're going to kind of dig through all of those options. But before we get started, I kind of want to talk through what happened from 2016 to 17. So I contacted my friend Joe Erickson with restaurantowner.com. How many of you in the room are familiar with restaurantowner.com? Yeah? Okay. So very good statistics. And so I asked Joe, I said, listen, I'm speaking at this conference. I'd like to share some real good information about the statistics of how are we growing in the economy. And what I noticed was from 2016 and 17 kind of fit into our financing. We found that 79% of the net income reporting for restaurants was greater than 1%. But interesting enough, the net income greater than 10% of sales was 31% of independent restaurants. That's significant. So I want to ask all of you in the room, from 2016 to 2017, did you see an increase in your net income? And if so, please raise your hand. Okay. Well, I mean, because here a majority, it would be 75% of you raising your hand. So, but you know, as far as we had 11% that net income was actually a net loss of greater than 1%. But these were pretty impressive numbers, because typically what we've seen in the past is usually between 5 and 7% of net income profit. Again, based on the 2016 and 17 financial performance trend, we've seen an improvement. 62% had an improving performance. What were the reasons that caused this improving net income performance? Most have expanded their restaurant space, opening additional locations, taking advantage of the opportunity of the economic market, and then also improving their guest experience, improving cost controls. But then on the flip side, we see some that say, you know, I'm not in that better position. I have government policies. 10% are reporting a worse performance by 10% of government policies, or as well as rising labor costs. So I know right now in New York, right now, labor cost is going up, you know, $15. That's significant. And I'm going to talk through on the next slide about how some of the restaurants in New York are actually taking advantage of technology to help with that increase of labor cost. And then they said, hey, increased competition. We're seeing more and more restaurants opening. We're having fewer customers. We need more capital because they're going to the other places. Well, everybody could have an argument that can either help you get more customers as there's more restaurants available, but here they say, this actually prevented me from having a better net income for 2017. So 2 years in a row, we did this show last year, and one of the things that was exciting is everybody was optimistic in 2017, and it's kind of exciting to see 65% of restaurateurs were also excited for 2018. We haven't had a recession, the economy still continues to grow, and a lot of that optimism is coming from improving business practices, the quality of the guest experience, improving economic conditions, and the quality of the employee experience. So this is what we're seeing, why people are optimistic. Those that are not so optimistic are concerned about challenging labor cost, but the biggest one I found as talking to restaurant owners, specifically in Texas, is the challenge of finding good employees. So that has been kind of a challenge. How do I keep my employees from staying and not leaving to go somewhere else, or just finding people? So that's why some have not been as optimistic. So this was kind of in line what I've seen as far as financing in the industry. And then the goals. What goals, and I don't know if this is in line with everybody in here, but what goals do you have as a restaurateur for this year? Again, most of everybody's goals is improving their profitability. We're having to make sure we're looking at every cost, reducing our cost. Well, sometimes that can be challenging. We all have, majority in this business has landlords. And so sometimes it's hard with some of those fixed costs, especially since labor costs are going up. But continuing to improve that guest experience, improving our business practices, and improving our staff training has helped. And those are the goals that we see, the top 5 goals for 2018 for restaurants this year. You also see on here, really quick before I move on, you'll see the improvement of management training, which this was a big one that restaurantowner.com had talked to Joe about, and outside of the labor. But he was talking, listen, there's right now, owners are really trying to understand their managers of what they're needing. And so this was a kind of initiative that I've seen some of my own clients really improving that management training to continue to improve employee performance and experience. So I'm going to keep going on. The good, the bad, and the ugly in today's financial market. As the good is, it continues to get easier to find funding. The banks are taking on more technology to improve speed to funding. So that's really super exciting in the industry as we see that. The bad is the larger fintech companies that are coming in that are lending to restaurants are getting aggressive. They're funding close to $5 billion. This number continues to grow. $5 billion in the market today to Small Business America. Are you familiar with financial technology companies out there, alternative lending space? So this market has just grown. But the ugly of this market is where we call them bad actors. So they see advantage of small businesses really needing capital. So we have these bad actors that come into the marketplace and, really charging a lot to small businesses and taking advantage of their cash flow needs. And it's actually causing small businesses to stack. which means that they're layering loans and cash advances on top of one another, and which leads to businesses closing and failure in the marketplace. So as a consultant out there speaking to restaurant owners, this is the biggest piece I would educate you on, is making sure that you have somebody that's guiding you to make sure you're not taking on too much debt that your business can actually afford to pay back. We see these aggressive companies saying, oh yeah, we can get you 25,000 by tomorrow. We can get you 50 grand by tomorrow. And before you know it, you've stacked a bunch of small loans on top of one another, and it causes a huge problem. And today, this is one of the biggest problems we have with small business in small business America today, is the stacking. Stacking, like I said, is a layering of many loans and advances at the same time. And the cause is cash flow is the biggest piece. I'll share with you, I had a business owner call me, and successful business owner doing about, 1.5 million in total revenue per month, and contacted me and said, hey, we found another unit we decided to open. I said, great. What do you need capital for? Sounds like things are going well. Well, we took on one of these advances because we were a little shy. And I said, okay. And I said, is that it? And they're like, well, no, we took on another. The same company called me. Before you know it, when I got through my complete debt analysis, there were 16 cash advances. $2.1 million of cash advances that were taken out through this business. And his projections, he couldn't debt service it. So, these are the things that cause where at some point, enough's enough. You have to take on, because just because somebody else is telling you can afford it, you have to look at it and say, does this make sense for my business? Should I take on this other advance? And at some point you have to, make a decision before you take on another advance, because the long term may not be good for you. So the risk of defaulting or closing your business, and then also violations of current lender agreements. If you're in a traditional bank loan, or if you did take on a short-term loan, you really need to evaluate that contract before starting to layer on top of some of these other contracts that you have. Because the last thing you want is a note to be called due because you're in violation or breach of contract. And so these are the things that we kind of guide through as consultants in the marketplace to make sure, hey, let's talk through this. Let's contact the bank. Let's make sure you're able to do this or this. So make sure you have somebody that you can trust when it comes to your money and financing your business. I'm gonna hand this back over to Steve to go through funding options.
Yeah, so last year when we kind of gave this talk, that last slide about layering and stacking wasn't in the presentation. It's really gotten bad, and most of you probably haven't been affected by it, but we run into it literally every day. We're approached by restaurants that had an air conditioning issue, and it was easy to get this money, and then that created other problems, and then they had to take another one, and it's just something to be very aware of. The real point of what we're trying to talk about today is, what are the different options in the space? I mean, you've got the traditional bank funding. Everyone should try to do that if they can. It's just that some banks are more difficult to work with than others for restaurants. Obviously, the SBA lending is usually pretty easy. Unsecured business loans and lines of credit, which is more of what we do. Equipment leasing. There's literally hundreds of companies out there that do equipment leasing. Merchant cash advances. Taking on equity partners or investors is often a way the restaurants go. Not always the best way, but certainly sometimes an easy way to go to get funding. And then friends and family is another way to look at it. So you need to figure out what are the best options for your business. You have to consider all of these different areas to decide which option is best. I mean, how quickly do you need the funding? Do you have all the documentation in place to get the funding? Because that can take some time to pull together. What is the personal credit of the guarantor or guarantors? The requested amount's got to match what that lender can do comfortably for the type of business. And then, of course, collateral requirements, real estate, equity in real estate, cash, those types of things. And then timing. I mean, for SBA lending, you can be looking at up to 6 months. Unsecured loans, a week or 10 days, maybe 2 weeks if you're spreading financials. MCAs or fintech companies can fund as quickly as same day, up to 7 days. And equipment leasing can be pretty quick, a couple weeks to a month. So you do definitely need to take into account how much time you have for your project when you need the money. SBA loan, they're going to take the most amount of paperwork on all the things you see here today. It is very popular for small businesses. The government has freed up new types of SBA funding over the last few years, but still you need to come up with usually around 20% down payment or equity to get an SBA loan. You've got to show at least 2 years of positive operating cash flow for the business. It's got to be a proven concept typically. And, they do prefer more food revenue than liquor revenue when they're looking at SBA loans. Terms are usually good though, 7 to 10 years. And the rates can be low, prime plus 2 or 3 points. So that's the upside to SBA. Minimum credit can be a challenge for some folks. They like to see around 650 or higher. And then, you've got to make sure you have all the documentation together. Obviously, financial statement, you've got to have for yourself personally and for the business, P&L, projections, ownership structure, any kind of certificates or licenses have got to be in order. And they want to see what other loans and applications and debt you might have in place. Obviously, tax returns, resumes for each of the principals, business overview, leases, all the typical things that you're going to be required for a bank loan. It takes a while to pull it together in many cases. So is this video? Okay. This video talks a little bit more about the approach that we take, more of a consultative approach to understand the needs, and we guide them into SBA, short-term business loans, equipment leases, that sort of thing.
Hi, my name's Celeste, and as a Senior Vice President at ARF Financial, I've heard countless firsthand stories from restaurant and hospitality business owners who struggle to get the funding they need or the loan terms that make sense to keep their business profitable and moving forward. If you're facing similar frustrations, don't worry, we're here to help. We understand the many challenges you face as a business owner and entrepreneur, and that's why we're committed to provide you access to the right loan product specifically designed for your individual business situation. As the restaurant industry experts with decades of experience, we've learned a thing or two about business owners like you. In fact, we've supported thousands of companies nationwide of all shapes and sizes to secure over $750 million in funding. And it doesn't matter if you're a single unit or a multi-unit operator or a nationally recognized chain, we will provide you the financial support you deserve. Let's face it, you have enough on your plate running your business. So why not leave the financial details to us? It's our job to understand your business goals, your financing needs, and then customize a loan to meet those needs, especially one that maximizes your return on your investment. So you might be wondering, what makes us different than other lenders? Well, it's actually pretty simple. We live and work in your community and are committed to work side by side with you to provide the financing you need to grow. We will guide you through the application process, make sure you get funded, and stick with you through the life of your business. Simply put, it's our mission to ensure your success. Just think of us as your local on-call personal financial consultant, and to ensure you receive the best possible loan terms, our company has secured exclusive relationships with banks across the country, so you can obtain funds quickly with limited paperwork and no need for collateral. And when you're working with us, there are no middlemen or brokers, so it keeps your costs low no matter what type of funding you're looking for. Let's hear from one of my clients who used our line of credit to transform her restaurant into a highly profitable concept.
Bear Bar and Cook Shop is a farm-to-table restaurant. We do global comfort food with local ingredients. It has been, for me, a 25-year process of finding short-term financing, just all dead ends, all dead ends. We met on a Monday and it was just like a done deal. It was amazing. We doubled our sales. We went from $1 million to almost $2 million. It was crazy. When you know what you need and know what you want, and then somebody says, here's the money, and you can just green light it, it's amazing. It's amazing.
We love to talk to clients just like you. You'll find us engaging, easy to work with, and there's no obligation to borrow as we discuss solutions for your business. To get started, simply fill out our online quote request and get ready to hear from one of our trusted advisors and see for yourself why businesses bank on us.
A little bit more about our unsecured loans, minimum loan of $5,000 up to $1 million per location. We will go higher than that. We have a new fund that where we do look at collateral over $750,000, $725,000. We'll go up to 3 years, 36 months, very little paperwork, quick process, 48-hour approval, funding in 5 to 7 days. We have nothing to do with credit cards. There's no type of percentage take rate or anything like that, like an MCA. These are small business loans with banks, and we do offer early payoff options as well. Obviously, there's all kinds of reasons to find working capital. Mostly expansion is what we like, ROI type projects, adding additional locations, augmenting what you're doing, making upgrades. But we also do loans for cash flow and for seasonal aspects as well. These are the types of loan products, from lines of credit to bridge loans to FlexPay loans, which are essentially a portion of the loan is interest only. So we do have bank-like products that we bring to the table, and we try to customize for each customer what your specific needs are. Equipment leasing is another area that you should certainly consider if you're expanding, adding equipment, adding locations. There's a company out there called LeaseQ that we work with. They have hundreds of banks that they work with for equipment leases. You can call us. We'd be happy to make an introduction to LeaseQ if you're looking for equipment leases, or you can contact them directly as well. Cash advance products, we talked a little bit earlier, mostly on the negative side about the layering and that sort of thing. Typically, they'll go to a lower credit score of around 400. Business has to be in place for 30 days. There's minimum requirements in terms of deposits and negative days and things like that that you would need to understand. Most of the cash advance loans are going to top out at around $125,000, $150,000, and will mostly be shorter term, 12 months or less. Typically, to get a cash advance, you'll need 4 months of bank statements, credit card statements, typical proof of ownership, K-1, driver's license, that sort of thing, and they'll probably want to talk to the landlord as well. Terms for cash advances are typically 4 to 12-month terms, rates of a 1.36 to a 1.45, and as you can see on these short terms, when those get layered and stacked one on top of each other, it can really create a problem. Some will go as high as 250, but that's a very large amount for a cash advance. Many still require some sort of a credit card split or a percentage of credit card sales for their repayment. Just something to be aware of. You know, in terms of equity versus borrowing, debt's usually less expensive than taking on a partner or providing equity. There's an opportunity cost also to taking on a partner and being, set up to pay that return year over year over year. It encourages some discipline to be able to pay back the loans, just like developing credit. And this is kind of a funny one that we put in at the end here, that borrowing from family and friends doesn't always make the best Thanksgiving. So I don't know if any of you have ever experienced that sort of thing, but it can be true.